Silver is breaking records at a pace the financial system was never designed to absorb. Prices have surged past $59 per ounce. Inventories are draining at the fastest rate since 1980, and global exchanges are showing signs of structural stress. Yet retail investors continue pouring billions into paper silver products such as SLV, instruments built on promises that weaken precisely when physical scarcity becomes real. This isn't a debate about volatility. It's a question of whether the financial vehicle most investors use can survive the very conditions driving silver higher. What stands out today is not the rally itself. It's the rising number of signals that the paper market is losing its ability to track the physical world it claims to represent. COMEX experienced a rare multi-hour outage just as silver spiked to new highs, followed by bid-ask spreads widening into levels typically associated with liquidity shocks. Soon after, major vaults reclassified metal away from deliverable status, effectively reducing the pool available for settlement. These are not the behaviors of a system in equilibrium. They are pressure valves opening in a market where obligations exceed resources. Behind the price surge sits a far more consequential development. The structural deficit in silver supply is no longer a forecast. It is measurable, persistent, and accelerating. 5 consecutive years of global shortfall have drained hundreds of millions of ounces from above-ground inventories, pushing registered COMEX stocks to levels representing only a few weeks of global industrial consumption. When a market built on leverage collides with a commodity experiencing real-world scarcity, the outcome is rarely ordered. This is why the risk is asymmetric. A holder of physical silver simply rides the volatility. A holder of paper silver faces something different. Counterparty dependence in a world where the counterparties themselves may lack sufficient depth. The system functions when demand is modest. It fractures when holders demand delivery, when industrial users begin hoarding, or when geopolitical stress forces nations to secure hard assets rather than paper claims on them. The warning is simple. Not because silver is rising, but because the structure that underpins paper silver weakens as the physical market tightens. In a market defined by scarcity, the asset with real value is the one you can actually hold, not the one someone else promises to find for you later. Silver's price surge is drawing global attention, but the deeper story lies in how the market infrastructure reacts under strain. The system built to mediate price discovery is displaying signs of imbalance, not because speculation is excessive, but because the paper layer has expanded far beyond the physical base that supports it. This divergence is no longer theoretical. It's visible in real-time market behavior that historically precedes structural breakage. One of the clearest signals came when COMEX experienced a multi-hour outage as silver spiked to new records. The official explanation pointed to a cooling failure, but the timing raised questions across institutional desks. When trading resumed, spreads widened sharply, revealing thin liquidity and growing hesitation among market makers to intermediate risk at prevailing prices. Markets don't behave this way when supply is healthy. They behave this way when participants begin doubting the system's ability to meet delivery obligations. Pressure intensified as metal began moving out of deliverable categories. Roughly 13.504 million ounces were shifted from registered to eligible, reducing the pool available for settlement at the moment of peak demand. Investors often overlook the distinction. Registered bars can satisfy futures delivery. Eligible bars cannot. Reclassification is a quiet signal that inventory managers prefer optionality over obligation. In a tightening market, that preference becomes a warning. At the same time, global inventories continue to contract. COMEX registered silver has fallen more than 50% from early 2021 levels, reaching volumes that represent only a fraction of annual industrial demand. London vaults show the same trajectory. The drain is not temporary or speculative. It is structural and persistent, driven by years of deficits that consumed more silver than mines could replace. Stress is emerging beyond Western exchanges. South Korean banks halted silver sales outright, removing retail access with no timetable for resumption. China tightened precious metal access for citizens while expanding state-level accumulation. And Russia remains barred from London trading floors, forcing physical procurement away from public channels and deeper into bilateral networks. These moves are not coordinated, but they reflect a shared reality. Physical silver is harder to source, and institutions prefer to secure supply rather than distribute it. The most telling indicator comes from pricing structure itself. Silver has entered backwardation, with spot prices exceeding futures, a rare condition in precious metals. Backwardation tells a simple truth. Investors are paying more to obtain silver immediately than to accept a promise of delivery in the future. In commodity markets, that inversion typically signals one thing: a shortage forming in real time. This is where the divergence becomes dangerous. Paper silver instruments, including ETFs and futures, depend on the assumption that physical supply is plentiful and deliverable. But the market is broadcasting the opposite. Inventories are falling, liquidity is thin, pricing structure is inverted. Regional banks and governments are restricting access. These are early phase symptoms of a market where paper claims are outgrowing the metal available to satisfy them. The present moment is not defined by speculation, it is defined by stress. And stress in a leveraged commodity system rarely resolves quietly. It forces a revaluation of where risk resides, not in silver itself, but in the instruments built to track it without holding it. The forces driving silver demand today are deeper and more durable than anything seen in previous cycles. Not because investors suddenly rediscovered the metal, but because the global economy has become structurally dependent on silver's physical properties. Behind the price movement sits a shift in industrial architecture, geopolitical hedging, and national energy policy, a combination that doesn't fade with market sentiment. The most powerful demand impulse comes from the energy transition. Solar installations now dominate global power expansion, and each crystalline silicon panel relies on silver paste for conductivity. The International Energy Agency expects annual solar build-outs to exceed 400 gigawatts within the next few years. At current loading rates, that translates into roughly 200 million ounces of silver consumed annually for photovoltaics alone, up from roughly 85 million ounces just a decade ago. But this isn't cyclical consumption, it's mandated infrastructure growth, backed by trillions in public incentives. Demand doesn't slow because price rises. Policy commitments turn silver into an essential industrial input, not discretionary. Electric vehicles add another layer of rigidity. Battery platforms, inverter systems, and onboard electronics require significantly more silver per unit than internal combustion engines. China, the world's largest EV producer, reported EV output rising more than 40% year over year, each vehicle embedding roughly double the silver of a gasoline counterpart. The auto industry is not merely adopting silver, it is absorbing it into a production model that scales annually. Once production lines are tooled for electrification, substitution becomes economically and technically costly. Digital infrastructure reinforces the trend. The rise of 5G networks, data centers supporting AI workloads, and advanced medical technologies all depend on silver's unmatched conductivity and antimicrobial characteristics. These applications are not sensitive to modest price increases. A data center or telecom firm pays for reliability, and silver's performance advantage over alternatives remains decisive. That makes this demand resilient, even in volatile macro conditions. Geopolitics pushes demand further. Russia's decision to formally designate silver as part of its strategic reserves marks a reversal of nearly 2 centuries of central bank disengagement from the metal. The allocation of more than 50 billion rubles for precious metal buildup between 2025 and 2027 signals a long-term commitment rather than opportunistic buying. Silver is becoming a reserve asset again in a world where currency weaponization and sanctions have reshaped the calculus of national wealth preservation. China's behavior adds complexity. Despite producing thousands of metric tons annually, its industrial machine consumes far more than it mines. With dominance in solar manufacturing, more than 80% of global panel output, and rising EV penetration, China imports significant quantities of silver while quietly restricting public access to retail purchases. Regulatory adjustments limiting citizen buying and emphasizing state-level accumulation suggest strategic hoarding rather than market participation. That is the behavior of a country planning for constrained supply, not stable equilibrium. Industrial consumption already represents nearly 60% of global silver demand, up sharply from a decade ago. This shift matters because it redirects silver from being a cyclical investment metal to a structural manufacturing input. Once consumed, much of this metal doesn't return to market for decades. Solar silver is locked inside panels for 25 to 30 years. Electronics recycling recovers only a fraction. Medical applications are single-use. As consumption deepens, every new technology node becomes another drain on supply. These forces create a demand curve that bends upward and stiffens at the same time. Economic softness can slow investment flows, but it cannot slow solar mandates, electrification targets, or national reserve strategies. In this environment, silver ceases to be just a hedge. It becomes a critical industrial commodity whose scarcity carries implications far beyond the investment community. The market's trajectory is shaped not by enthusiasm, but by necessity. And necessity is the one driver that does not pause when supply becomes tight. It accelerates. The pressures on silver supply are not emerging from temporary disruptions. They stem from structural limits embedded deep within the industry's geology, cost frameworks, and production cycles. These limits shape a supply curve that cannot respond to rising demand in any meaningful time frame. Prices can rise quickly, production cannot. And that mismatch defines the vulnerability of the entire paper-silver ecosystem. Global mine output has been sliding for years. Production peaked in the mid-2010s and has since trended downward, falling roughly 7% from 2016 levels, according to industry reporting. The decline is not due to lack of effort. It reflects a geological constraint. The era of large, high-grade, easily mined silver deposits is over. What remains is deeper, lower-grade ore, requiring more capital, more energy, and more environmental permitting, all of which extend development timelines beyond what rising demand requires. The structure of supply compounds the problem. About 70% of all silver comes as a byproduct of mining for copper, lead, zinc, and gold. That means silver production does not respond to silver prices. It responds to the economics of other metals. When copper or zinc prices stagnate, the incentive to expand output disappears, and the silver that depends on it disappears with it. This dynamic leaves the market with a rigid, slow-moving supply pipeline, even as industrial demand accelerates year after year. Recycling, often promoted as a buffer for shortages, offers little relief. Electronics capture only small traces of silver, and recovery rates hover near 20% in many categories. The solar industry is even more problematic. Panels lock silver away for 25 to 30 years before end-of-life recovery becomes possible. Medical and antimicrobial uses consume silver permanently. In 2024, recycled material reached roughly 194 million ounces. Meaningful, but nowhere near enough to close a deficit approaching 150 million ounces annually. The gap persists because recycling mirrors production, slow, rigid, and unable to scale on demand. This structural deficit has forced the market to rely on above-ground inventories, the final reservoir that keeps spot prices anchored. But that reservoir is shrinking at an unprecedented rate. COMEX registered silver fell from about 80 million ounces in late 2024 to roughly 43 million ounces by December 2025. The most dramatic moment came when 6 million ounces drained from vaults in just 47 days, a pace unseen since the 1980 crisis. London vaults show a similar contraction, with inventories sliding toward multi-decade lows as industrial users and sovereign buyers absorb available supply. Inventory reclassification underscores the trend. When a major institution shifts metal from registered to eligible, the metal remains in storage but is removed from the pool available for delivery. This maneuver increased sharply as prices climbed. JP Morgan alone reclassified about 13.4 million ounces, reducing what the futures market could rely on for settlement during a period of heightened demand. Reclassification doesn't signal abundance. It signals reluctance to part with it. In a balanced market, shortages can be resolved by higher prices, incentivizing new production. But silver's supply structure blocks that mechanism. New mines require 7 to 10 years of development, and byproduct dependency cannot accelerate even under extreme price conditions. The result is a chronic disconnect. consumption rises immediately, while supply responds over a decade, if capital, permitting, and ore grades allow it at all. This creates a fundamental reality. The paper market assumes liquidity. The physical market no longer provides it. As inventories decline, each additional ounce removed from the system raises the risk that futures contracts, ETFs, and other paper instruments represent claims that cannot be met. The stability of paper silver relies on the depth of deliverable stock, and that stock is shrinking faster than any part of the industry can replenish. The constraint is not speculative. It is geological. It is structural. And it places mounting pressure on a financial system built on the assumption that silver is abundant, interchangeable, and easily delivered. Those assumptions no longer hold. The tension in the silver market does not emerge when prices rise. It emerges when the chain linking futures contracts, ETFs, vault inventories, and physical delivery begins to stretch beyond its limits. A paper market can function with leverage. It cannot function without metal. And as available supply tightens, the mechanisms designed to provide liquidity begin revealing the fragility embedded in the system. The first pressure point appears in leverage ratios. The futures market routinely supports open interest representing hundreds of millions of ounces, even though deliverable COMEX inventory sits at a fraction of that amount. At one point, open interest equaled 244% of all vaulted silver, implying that more than 2 paper claims existed for every ounce in storage. When measured against registered silver, the metal actually available for delivery, exposure reached far higher levels, creating a dependence on the assumption that most contracts will never request physical settlement. The system works only if everyone behaves as expected. It breaks when expectations shift. Backwardation is the next signal. When spot silver trades above futures, markets reveal an unwillingness to wait for delivery. That inversion has already emerged across multiple venues, indicating that buyers distrust the promise of future fulfillment and prefer immediate possession instead. In precious metals, backwardation is rare because storage costs, financing rates, and inventory buffers normally keep futures priced above spot. When those buffers evaporate, the curve collapses inward. The financial structure begins bending under stress. Institutional behavior reinforces that stress. Major banks and sovereign buyers have quietly withdrawn metal from the deliverable pool, reclassifying inventory and reducing available supply at moments when the market needs it most. JP Morgan's shift of 13.4 million ounces from registered to eligible removed a significant portion of potential settlement metal, just as prices surged and physical demand intensified. When banks pull metal from the system, they are not signaling confidence in paper liquidity. They are signaling caution about future availability. These stresses trigger reactions that ripple through the financial side of the market. Trading halts, like the COMEX outage that coincided with silver's intraday breakout, expose the vulnerability of systems built to absorb large, complex flows of derivative contracts. The official explanation referenced a cooling failure, but during the halt, silver spiked to new highs and spreads widened afterward, behavior consistent with the market-facing imbalance between paper obligations and physical supply. The outage mattered not for its cause, but for what it revealed. When liquidity is thin, even minor disruptions produce outsized moves. As strain builds, precedents offer a roadmap. When the Hunt brothers forced delivery at scale in 1980, the exchange responded by altering rules, freezing new long positions, and raising margin requirements overnight. The structure bent sharply because physical supply could not cover leverage claims. The collapse that followed was not the result of excessive price alone. It was the recognition that the system's obligations exceeded its metal. The same phenomenon appeared in palladium 2 decades later, when Russian shipment delays triggered delivery failures, contract stress, and a price that surged more than 6-fold before substitution became viable. Silver now sits in a similar position. Inventories are falling, demand is rising, paper claims continue expanding, and institutions are withdrawing metal at the precise moment paper products attract the most inflows. Even national policies reflect this shift. South Korean banks halted silver sales indefinitely. China tightened citizen access, and Russia structured formal reserve purchases, all signaling a pivot from distribution to accumulation as scarcity intensifies. For the paper market, the tipping point arrives when confidence breaks. ETFs rely on authorized participants to source metal when shares are created or redeemed. Futures rely on warehouses to meet delivery requests. Both rely on the assumption that physical supply exists in sufficient volume. SLV and similar vehicles include provisions permitting cash settlement, not metal settlement, when sourcing becomes impractical. A feature often overlooked until conditions make it relevant. Under normal circumstances, these clauses barely matter. Under shortage conditions, they define the instrument's true nature. This is where chain reactions become decisive. Once participants realize paper instruments cannot secure guaranteed metal, demand rotates toward physical holdings. That shift drains inventories further, tightening markets and amplifying backwardation. Liquidity thins. Exchanges respond defensively. Rule changes, margin escalations, delivery deferrals, and forced cash settlements become tools to preserve system stability. Each action reinforces the idea that paper claims are not equivalent to metal. The dynamic is predictable. Stress introduces doubt. Doubt becomes precaution. Precaution becomes withdrawal. And withdrawal, whether by banks, sovereign buyers, or industrial users, accelerates the very shortage the paper market is least equipped to handle. In this environment, the risk is not that silver becomes overpriced. The risk is that the financial infrastructure designed to track silver becomes structurally brittle in the face of tightening supply. The moment paper claims exceed confidence in delivery, the price mechanism changes. Futures no longer anchor the market, physical availability does. And once that shift occurs, the instruments most relied upon by retail investors, SLV, certificates, unallocated accounts, become the least reliable in the entire system. The next phase of the silver market will not be defined by price targets or speculative forecasts. It will be defined by the interaction between structural scarcity and a financial system that has relied for decades on the assumption that physical supply is abundant. That assumption is weakening, and as inventories fall, the risks shift not toward volatility, but toward a breakdown in how the market functions. The most immediate pressure sits within the delivery system. If COMEX registered inventories fall below a threshold, often cited near 50 million ounces, the market enters a zone where ordinary settlement flows begin competing with industrial and sovereign demand. Registered stock has already declined to levels implying only weeks of global consumption, and drain rates suggest further contraction ahead. When availability shrinks this far, the futures market's role as a price anchor becomes uncertain. Participants begin to question whether financial claims can remain interchangeable with metal. A similar shift appears in the ETF ecosystem. As demand rises, SLV and other paper vehicles depend on authorized participants to source metal. But sourcing metal at scale requires a liquid physical market, not one where inventories fall by 37.6 million ounces in 47 days, and banks actively reclassify holdings away from deliverable categories. In a tightening environment, the ETF structure's obligation converts from physical certainty to conditional availability. The mechanism still works, until it doesn't. And when stress emerges, the option for cash settlements becomes more than a footnote. Industry behavior will amplify that shift. Silver is not merely an investment metal. It is a feedstock for energy infrastructure, defense, and electronics. Industrial users facing multi-year contracts cannot afford supply disruption. Once procurement officers perceive delivery risk, stockpiling accelerates. This dynamic already appears in market data, with solar manufacturers and electronics producers expanding inventory purchases as deficits widen. Demand becomes preventive rather than reactive, and preventive demand pushes shortages forward in time. Geopolitical factors tighten the timeline further. China's restrictions on citizen purchases, South Korea's suspension of bank sales, and Russia's adoption of silver as a strategic reserve all indicate a shift away from open distribution towards state-level accumulation. When sovereigns act as long-horizon buyers, supply does not return to market. It disappears from circulation. This changes silver's role from cyclical commodity to strategic asset, one held, not traded. Financial markets respond to these pressures through rule adjustments. The industry has precedents: palladium's cash settlement episodes, nickel's trading cancellations in 2022, and the 1980s silver rule changes that froze new long positions. When obligations exceed resources, exchanges prioritize stability over fairness. Silver could encounter similar outcomes if drain rates continue and delivery queues lengthen. Margin increases, position limits, modified delivery rules, all are possible tools in a market where structural imbalance replaces temporary dislocation. These pressures converge on a single point. The risk is asymmetric. Silver's upside is driven by demand that policy, industry, and geopolitics reinforce. Its downside is dampened by deficits that show no sign of reversing. But paper silver sits in the inverse position. Its upside is capped by structural limitations, while its downside expands as confidence in deliverability erodes. For physical metal, scarcity raises value. For paper instruments, scarcity raises doubt. This is the landscape forming ahead. A tighter market, a thinner inventory base, a growing divergence between financial claims and physical supply, and a rising probability that paper structures face stress before the underlying commodity reaches equilibrium. In such an environment, the center of gravity shifts. It moves away from futures curves and ETF prospectuses. It moves toward refinery output, vault inventory, and industrial procurement cycles. The path forward does not depend on speculative enthusiasm.
It depends on arithmetic. When consumption exceeds production, inventories fall. When inventories fall, financial structures built in abundance begin to unwind. And when that unwinding starts, the instruments least connected to physical ownership bear the greatest risk. The forces reshaping the silver market are not speculative waves. They are structural pressures that intensify as inventories shrink, industrial demand expands, and geopolitical actors reposition their reserves toward tangible assets. Price volatility becomes secondary in a system where the real risk lies not in silver's movement, but in the reliability of instruments designed to track it. Paper silver depends on the assumption that metal is plentiful, deliverable, and interchangeable with financial claims. That assumption weakens as every indicator points toward tightening supply. In this environment, the distinction between ownership and exposure becomes decisive. Physical silver benefits from scarcity. Paper silver is threatened by it.
The mechanisms supporting futures contracts, ETFs, and unallocated accounts function only while confidence remains intact. When inventories decline, when industrial procurement accelerates, when sovereign accumulation removes metal from circulation, that confidence becomes harder to justify. The consequence is not a temporary mispricing. It is the possibility that paper structures detach from the very asset they represent. The market is already signaling this shift. Backwardation, delivery stress, vault reclassification, and regional restrictions reveal a system adjusting to scarcity rather than abundance. These signals do not guarantee crisis, but they challenge the belief that paper instruments can navigate a physical shortage without disruption. In a market shaped by deficits, the claims with the least connection to metal carry the greatest risk.
Silver's trajectory will be defined by fundamentals that strengthen, not weaken, with time.
Accelerating industrial consumption, limited mine growth, constrained recycling, and strategic accumulation by nations seeking insulation from monetary volatility. As these forces converge, they elevate the importance of holding the asset itself rather than a promise of it. The warning is clear because the structure demands clarity. Paper silver offers exposure, not certainty. Physical silver offers certainty, not exposure. In a market moving steadily towards scarcity, only one of those positions remains aligned with the underlying reality.